Welcome to the Clarity Podcast, the podcast where you gain clarity on starting up, career, and life. In this episode of the Clarity Podcast, you will gain clarity on venture capital or VC as we call it. If you are a startup that's looking to raise money, or if you are somebody wanting to build your career in venture capital or investing, then this is the podcast for you. Listen until the very end. This entire podcast has been divided into 7 chapters, and we will talk about all of those chapters one by one. The first is what is venture capital? The second is why does venture capital exist? The third is where does the money come from? Where does it go? Chapter number 4 will be do VCs ever fail? Chapter number 5 is how do VCs really decide to invest? Chapter number 6 is how do VC teams they earn their monthly income? And chapter number 7 is can anybody become a VC? If you want to be a venture capitalist, can you do that? Before we go further, I must thank the entire team at MBA Plus Clarity for sponsoring the Clarity podcast. If you want to know what MBA Plus is, go download their app on the Android store or iOS. MBA Plus is an incredible community of startup founders, entrepreneurs, and aspiring entrepreneurs across the world. They learn with great quality content that's published in the MBA Plus app, and Clarity Podcast is part of it. Before we go further, I must thank again the entire MBA Plus Clarity team. Now let's get started. Chapter number 1. What is VC? Venture capital or VC is private money invested in private companies. Private companies are companies which have not really gone public yet, which means that they're not really yet listed in the stock markets. Now, venture capital is not just money. While it is called venture capital, it is money plus resources plus a lot of clarity that a VC actually comes on board a startup with. Remember the fact that a venture capital, money or a VC or a fund might or might not be patient capital for you. Now, what does that mean? Look, when you build a company and when you want to take an exit in terms of an IPO, generally for a company to go IPO takes about 10 to 12 years, or even for you to take a large exit, it takes about 10 to 12 years, right? It takes that time to build a company, a strong company. But generally, most VCs or most venture capitalists will have their funds. Every time they would raise a fund, they would launch a fund. They would have a general investing and an exit time frame of about 6 to 8 years. Now, this entire time frame is much shorter compared to what it takes for building, to build a large company, right, which is 10 to 12 years. So, as a founder, you really need to understand that VCs, every fund that they launch has a limited time frame, and hence you need to, and that's why VCs want a lot of speed, operational speed from you, good decisions from you, and that's why they would invest only in probably the most experienced founders or the founders that they can really trust upon, right? Because speed is really critical. Chapter number 2: why does the VC exist? Realize first money, right? Now, where does money really come from? Of course, you can print money, but largely money really comes into the system by the banking ecosystem. Now, the banking ecosystem is very, very slow, and it is very tough to get money from, right? I mean, you can't really go to a bank and say, I'm a startup, and the bank will suddenly fund you. No, they won't, right? And then comes the private equity ecosystem. Now, the private equity players, they come into a company at a much later growth stage, right? VCs, they really get in early, right? Venture capitalists understand the risk and the rewards in this state. Now, in this entire ecosystem, there are 3 actors at play, which we will also talk about, right? But right now, what you need to just understand is that VCs exist because the banks are too slow, and it is tough to get money from them. PEs, they invest at a much larger stage, and that's where VCs really come into the picture. Now, VCs, as I said, don't just invest money, they bring in resources, they bring in network, and they also bring in a lot of clarity, which is so very important for young founders or early stage founders, because look, your business will evolve. It will change. A lot will happen throughout the course of your business. You will pivot. You will launch newer products. You'll launch newer brands. You'll do a lot of mistakes, and that's where the VCs or the entire network that they'll sort of bring in, it will help you overcome or build a lot more better, a lot more faster, and be more successful. Chapter number 3. Now, where does the money come from, and where does the money really go? Before we understand where does the whole money equation fit in, let's understand the 3 most important ecosystem players. So they are the LP, the GP, and the entrepreneur. The LP is the limited partner, the GP is the general partner, which is the VC fund, and the entrepreneur is the person who is taking the money. So the limited partner is generally somebody with a lot of money. These are extremely wealthy families, pension funds, insurance companies. They are the ones with a lot of money. Now they generally don't invest in startups directly, of course, because they have to manage the entire portfolio. So what they generally do is they would give about 5 to 10% or a chunk of their money to the venture capitalists, invest in their fund, and of course expect a much higher return compared to investing the same money in either stocks or mutual funds or any other asset class, right? So the LPs really understand the risk and the rewards associated, and that's why it's only a small proportion of their entire asset base that they invest with a VC. LPs, as I said, are pension funds. They are wealthy families. They are very, very large asset management companies. Now, one venture capitalist could have multiple LPs as well, of course. It depends upon the size of the fund that you've created. Let's just say that I am starting up right now as a fund. Let's say tomorrow if I launch a new fund. Now, I don't have previous experience in running venture capital funds, and hence, I might just start with a small fund. It could just be a $5 or $10 million fund, right? Because not a lot of LPs would really bet their cards on me. But of course, once my first fund generates results and I become a lot more successful, more LPs will come on board, and my second fund might be a $50 million fund, and then a $100 million fund, and so on and so forth. So depends upon the size of the fund that you're creating. You would need more LPs. Now, the job of the VC in this entire equation is to find companies that will create extraordinary returns, right? This is not a 1x or a 2x or a 3x return. We're talking extraordinary returns here. Only then do VCs make money, and only then will they be able to return it back to the LP. Now, one reality of venture capital industry, and you need to really understand this, because where does the money come from and where does the money go? A lot of money goes down the drain as well, because a lot of companies are just not successful. They bomb. They fail to create what they really set out to create. Now, you can't really blame the entrepreneurs. There are several factors at play there, but fundamentally, if you see, a lot of VCs hence really bet their cards on a few companies that become extraordinarily successful, and that's why they would want to carry on into a trend and only invest in such founders or such ideas. Chapter number 4: do VCs ever fail? The quick answer, of course, is yes. If the fund it fails to give the promised returns to the LP, the fund has fundamentally failed, right? Now, VCs largely are not future gazers. Now, these are not guys who are so good at investing that they would return a certain percentage to the LP every time. It is just not possible, right? I mean, there are just too many factors at play to really guarantee return. Even the government cannot guarantee returns to you today, right? So, but what the VCs do is they work with a lot of data, they work with a lot of trends, they work with a lot of operating experience of their partners and their teams, and that's why, of course, they are able to largely not predict, but also hustle hard and work hard with their portfolio companies to generate returns. VCs hence, build to sort of minimize their risk, and risk of their investments going wrong. They build an entire ecosystem of people around them, right? Ecosystem of resources around, and that's really important for the VCs. Otherwise, of course, they will fail, right? It's as simple as that. Chapter number 5, extremely important. How do VCs they decide to invest? Now, look, VCs generally follow a general framework. Now, the first thing that you need to understand is the theme. Every fund has a theme. Now, there could be VCs who would say that we would only invest in health. We will only invest in EVs, electronic vehicles. We would only invest in a certain sector, like a lot of sectoral mutual funds, right? Some VCs might just say that we are sector agnostic, right? We are idea, VC. If we like somebody, if we like a great team, we'll just go ahead and invest, right? The second is time of investment. When I say time, I mean time frame of the fund. So, once you've raised a fund as a VC, is it 6 to 8 years? Is it 8 to 10 years? What's the investing time frame that you have? Because then you have to invest, grow the company, exit from the company, and make returns, right? Then is the IRR, which is the internal rate of return. I'm not going to discuss IRR in this particular podcast, but if you like it, of course, we talk about it in the later podcasts, or I could actually invite over an investor to talk about IRR. But largely understanding greater the IRR, better the fund. Then comes the term sheet clauses, very, very important, both for the investor as well as for the founder. Look, when the investor is investing in you as a founder, the investor of course wants to make return. They want to see you successful, but they also want to safeguard their existence in your company. So for example, the VCs, they reduce their risk by optimizing for decision making. They want board seats. They might want board seats. They might want voting rights, and they also might want preferred equity, instead of just common equity or shares in the company, right? So, and that's where founders generally, have to negotiate. But I would always, tell you as the Clarity podcast that look, you don't really have to negotiate here. What you really need to do is understand that a venture capitalist or a VC or an investor is minimizing their risk. You have to minimize your risk, and you have to have just a great, honest conversation with the investor, and come to a common ground rather than really making it a very hard, very tough negotiation, deal, because they want to see you successful as well, right? And you want to have a great investor and not just a pain in the head, right? Really, or a pain in the back, so to say. Chapter number 6. How do VC teams earn their monthly salaries, right? So if you join a VC team tomorrow, how do you make a monthly salary? There are two ways they do it. Number one is a fee. So let's just say that you are running a $10 million fund. I mean, your total fund is $10 million strong. So you would charge about 2% of an annual fee, to manage and invest that money. From the LP. So the LPs know that you're charging a 2% fee, and that's your basic running or operating expenses. The second is something that they call carry. Just like when you start working in companies, you get bonus, right? So think of carry like a bonus, right? It's a bonus that you get. About 20% of the profits that you make in the fund is your carry, and the venture capitalists really make a lot more money in the carry. So, and it makes a lot more sense as well. Look, if the carry is large and if you're running for it, you would your skin is in the game, right? Because that's then not just the LP's money being played with, but you are really wanting to be successful. Chapter number 7, and the last chapter of this podcast. Can anybody be a VC? In theory, yes, anybody can be a VC. I mean, you could have a rich father or a super rich father-in-law, and you could get 2 checks from them and sort of start a fund, right? In theory, yes, you could be a VC. Of course, you do have to go through certain regulatory bodies to really register yourself as a fund. But in real life, if you can convince LPs and get them to write checks to you, that's when you really become a venture capitalist. You must be able to attract great deal flow. That's the starting point. Deal flow means you must be able to attract great startup founders to you, right? Startup founders must want to get your check. They must fight to get your check. They must fight to get you on board their company, right? You must be able to hire smart growth managers, and you must have huge respect in the ecosystem, right? If you do not, if you do not have that respect in the ecosystem, look, people wouldn't want to work with you. Just having money in the bank, just having LPs with you would not really work if startup founders don't want to work with you, right? So you have to really be out there to help startups, support startups, and help them, to grow their ventures. That's what you stand for, right? So thank you so much for joining us in this Clarity podcast today. I hope you really liked it. Do come to our YouTube channel, subscribe, share, like our Clarity podcast, and also comment. Tell us, what more clarity do you need for starting up, for your career and your life. And before we wrap up this episode of the podcast, go download the MBA Plus app on Android. They're by the name of MBA Plus. On iOS, they're by the name of My Institute app, with the code PBMDH. Go check them out and check out a lot of great content that they publish. We also, by the way, publish a lot of Clarity podcasts in MBA Plus app, a lot of paid content that we generally don't publish on our YouTube channel. On that note, thank you so very much for joining us today on the Clarity podcast. I will meet you very, very soon with some phenomenal, fascinating startup founders, innovators, people who have failed and who have been successful in life, such that they could give you the most important thing that matters to you, and that is clarity. Thank you so very much. I wish you all the very best. Jai Hind.